Headline inflation just turned negative for the first time since 2020, even as oil stays near recent highs and bond yields remain elevated. That collision is forcing equities to rethink the path of rates, sector leadership, and how durable the AI and bank rallies really are. You are watching vTalkInsight, Equity Pulse Daily for July 15, 2026. Let's get straight into what this new macro mix means for stocks. The dominant macro story right now is the clash between a softer inflation print and a harder energy shock. That tension is reshaping how equities think about both the Federal Reserve and earnings resilience. The latest US inflation data delivered a genuine downside surprise. Headline CPI fell about 0.4% month-on-month, the first negative reading since 2020, while core CPI was flat, pulling year-on-year core down to roughly 2.6% from 2.9%. Categories like airline fares, electricity, auto insurance, and tobacco did a lot of the work, and headline year-on-year dropped from around 4.2 to 3.5%. Markets reacted quickly. Two-year Treasury yields fell more than 10 basis points, the S&P 500 and Nasdaq 100 advanced, and high-yield credit spreads in BB space pushed toward new cycle tights. That combination points to a renewed tilt toward risk-on, underpinned by very benign public credit conditions. Even so, the Fed is not declaring victory. Officials have reiterated their commitment to restoring price stability and avoided giving explicit guidance on the next move. Fed Governor Christopher Waller has been clear that if core inflation were to re-accelerate, renewed tightening would be back on the table, so the market's relief on a July hike does not eliminate higher-for-longer risk. That higher-for-longer concern is visible further out the curve. 10-year Treasury yields are hovering near 5%, and global bond markets have seen a notable sell-off, with European and UK yields up as much as 10 basis points recently. Higher real yields keep a lid on equity valuations, even as the disinflation story improves. Japan is the outlier. A very strong 20-year government bond auction and talk of tax-advantaged savings vehicles for Japanese government bonds have pulled local yields sharply lower. Policymakers are effectively encouraging domestic demand for JGBs, which could also support the yen if those measures are formalized. Offsetting the disinflation surprise is a powerful energy shock. Escalating tensions in the Strait of Hormuz, including U.S. naval blockades, proposed transit fees, and attacks on regional shipping, have driven Brent crude into the mid to high 80s and pushed tanker traffic towards standstill levels. Refined products look even tighter, with U.S. refinery utilization around 96% and China holding back spare capacity, while export bans in parts of the world keep diesel and gasoline prices sticky. U.S. gasoline averages are near $3.85 a gallon with limited quick policy levers, and European bond yields are reacting to higher inflation expectations tied to rising oil. Yet at the same time, the broader growth backdrop remains constructive. China's exports hit a record $412 billion in June, with AI-related goods driving a 27% year-on-year surge, and U.S. banks continue to report a resilient consumer. Taken together, equities are facing friendlier near-term inflation data, but a noisier medium-term path, which keeps the rate debate front and center as we move into the heart of earnings season. Against that macro backdrop, the banking sector is acting as both a barometer and a driver of equity risk appetite. Globally, bank stocks have regained leadership, with roughly 99% of the sector trading above its 200-day moving average heading into second quarter results. Fundamentals are lining up with that technical strength. Median earnings per share growth for U.S. banks is expected around 17% year-on-year, and global deal activity has reached about $2.5 trillion in the first half, putting 2024 on pace to surpass the 2021 record. Volatility in oil, geopolitics, and AI has translated into very strong trading revenues, particularly in equities. The big U.S. franchises underscore the story. J.P. Morgan has reversed an earlier downgrade to its outlook and now guides full-year net interest income to roughly $105.5 billion, signaling stronger than expected core profitability. Bank of America has delivered about 15% revenue growth with more than 600 basis points of positive operating leverage, pointing to real efficiency gains. On Wall Street, Goldman Sachs reported roughly $7.42 billion of equity sales and trading revenue, beating estimates by about $2.4 billion and marking a third consecutive all-time high. Wealth management at Morgan Stanley continues to provide a more stable, cycle-resistant revenue mix, while the sector as a whole is returning substantial capital through higher dividends and over $100 billion of announced buybacks. Credit quality at the large banks remains solid, with charge-offs at JP Morgan and Wells Fargo coming in below expectations. The nuance is that strong numbers are not always translating into higher share prices. JP Morgan and Bank of America both reported record or near-record profits, yet their stocks barely moved or slipped, suggesting investors are using good news to trim exposure rather than chase it. At the same time, operating expenses are rising, with Citigroup surprising the market by announcing roughly $5 billion of accelerated investment across cards, marketing, AI, and talent. Beyond listed banks, public credit remains very supportive, with BB spreads at new cycle tights in the US and Europe. Private credit is more mixed. Retail investors, particularly in Asia, are pulling back, while institutional allocations continue to grow. Apollo Global Management, for example, is on track for a record year in acquisitions and has tilted more than 80% of its assets toward investment-grade credit, highlighting a preference for safer yield even as risk assets broadly look firm. For equities, the message from the banks and the credit complex is that financial conditions are still easy, but the bar for positive earnings surprises is rising. The other major axis for equity markets is the AI buildout, which is increasingly an infrastructure and balance sheet story, not just a growth narrative. The scale of AI-related capital expenditure is described as unprecedented, with large U.S. hyperscalers expected to account for up to 10% of the entire investment-grade credit market by year-end. Data center operators are looking to monetize this demand by selling majority equity stakes to private equity, and global trade data show AI pulling through real volume. Exports tied to AI demand have driven a 27% year-on-year surge and the fastest import growth in 5 years. On the constraint side, PJM, the largest U.S. grid operator, failed to procure enough future electricity supply in its latest auction, underscoring how power availability is becoming a binding factor for AI and data center growth. In equity space, leadership has clearly shifted toward hardware, memory, and physical infrastructure. Investor focus is moving from traditional software toward compute, storage, and networking, which is benefiting companies like NVIDIA, AMD, Intel, Micron, SK Hynix, and SanDisk. Semiconductor stocks have rebounded sharply, led by AMD and SK Hynix, as analysts raise price targets on expectations for robust AI-driven data center demand and more than 50% unit growth for some platforms next year. SK Hynix has become a bellwether for AI memory demand and the interconnectedness of US and Korean tech markets. Its American depository receipts recently dropped sharply before rebounding more than 6%, with extreme swings attributed largely to leveraged ETF rebalancing and trading mechanics rather than fundamentals. Despite the volatility, SK Hynix is trading at less than 4 times next year's earnings, suggesting that parts of the memory complex are seen as inexpensive relative to recent moves. By contrast, the economics at the model and platform layer look more fragile. Pricing for leading AI models has compressed dramatically, with costs per million tokens falling from over $50 to as low as 50 cents in some cases. The performance gap between top models is narrowing, meaning cheaper alternatives are often good enough for most enterprise use cases. Customer loyalty is proving thin. Users are quick to threaten switching providers when pricing or access terms change. Concerns around privacy promises, such as so-called zero data retention, persist because of technical limitations, and unpredictable business practices at large AI labs are starting to be seen as a systemic risk for the wider tech sector given their growing market capitalizations. Enterprise IT budgets are already reacting. IBM's preliminary results showed significant weakness in both software and infrastructure segments as clients shifted spending toward servers, storage, and memory ahead of expected price increases. Software revenue grew around 5%, well below a roughly 10% expectation, while infrastructure revenue declined about 7%. IBM's chief executive acknowledged underestimating the scale of this capex reprioritization, with heightened cybersecurity concerns also freezing parts of the IT spending pipeline. The stock responded with its steepest single-day decline in decades, dropping in the high teens to around 20% and triggering a broader sell-off in software names via ETFs. Peers such as ServiceNow and Workday came under pressure, reinforcing a pattern this earnings season where misses are punished severely while beats often receive only muted rewards. For the AI complex, it raises the question of how long hardware and memory can outrun the monetization pace of software, models, and cloud services. Apple has become a focal point for how investors price AI optionality against valuation and execution risk. The company is undergoing a CEO transition, with Tim Cook stepping back from daily operations, just as it leans into what many see as its next major growth phase, integrating AI tightly with hardware. Apple is preparing a pipeline of 6 AI-enabled devices over the next 2 years, including smart glasses, AI-powered AirPods, a wearable pendant, and a smart home hub, alongside meaningful improvements to Siri that make it far more capable for most users. Strategically, Apple is betting on running models locally on devices to strengthen privacy and ecosystem stickiness, while drawing on access to advanced models from partners such as Google. That local-first AI approach could pay off, but it also creates new risks. If on-device models underperform cloud-based alternatives, Apple services and engagement metrics could suffer. At the same time, advances from firms like Prism ML in compressing large language models may reduce the amount of memory and GPU needed in devices, potentially capping some of the upside investors expect for DRAM and data center chips. Morgan Stanley projects Apple's memory costs could surge about 190% next year, though more efficient models might limit that increase. Near-term revenue may also have been flattered by pull-forward demand in China. Apple TV remains loss-making as a marketing funnel, and a rumored foldable iPhone priced above $2,000 faces skepticism on mass-market adoption. With Apple trading at peak price earnings multiples and some analysts downgrading the stock, the company encapsulates the broader debate over how much AI premium is already embedded in megacap tech. Beyond Apple, sector rotation mirrors the macro crosscurrents. European energy stocks are outperforming as Brent trades above $85 and Middle East disruptions lift oil majors and shipping companies such as Hapag-Lloyd and Maersk through higher container rates and tighter capacity. Travel, leisure, and parts of the luxury complex are lagging, even though a strong U.S. wealth effect is still supporting brands like Watches of Switzerland. In the U.S., small business optimism and bank commentary on Main Street resilience back the case for a soft landing and support the argument for stronger small and mid-cap performance relative to crowded large caps. Offsetting that, rising long-term yields, a surge in equity supply from capital raises and high-profile listings by groups such as Alphabet and SpaceX, and greater antitrust scrutiny on deals like the Paramount merger all add friction. Combined with calls to reform IPO and SPAC structures for better alignment and regulatory concern over leveraged ETFs after extreme swings in names like SK Hynix, the message is that market plumbing and policy are becoming as important as macro in driving the next phase of equity returns. Stepping back, equities are sitting at the intersection of 3 powerful forces. A meaningful downside surprise in U.S. inflation has eased immediate pressure for further Fed hikes, but an ongoing energy and shipping shock, elevated long-term yields, and noisy geopolitics keep the medium-term inflation path uncertain. At the same time, bank earnings, tight credit spreads, and resilient consumers argue for a soft landing rather than an imminent downturn. Within that macro frame, leadership is concentrated in AI-related hardware, memory, and financials, while software and some richly valued megacaps face a much higher bar on execution. The market is rewarding scale, balance sheet strength, and clear cash flow, but punishing even modest earnings disappointments, as IBM's move showed. Looking ahead, the key signals to watch are follow-up inflation prints and Fed communication, the trajectory of oil and refined products, the next wave of bank and semiconductor results, and how easily the market absorbs a heavy IPO and capital raising calendar. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.